We are now on the step 2 of the accounting cycle, which is the recording of transactions, or what others call the journalizing phase. So this is the third episode already of the accounting cycle series. So before you continue with this one, please see video number 1 and video number 2 first. The link is on the description below. And for those who already did that, let's start this video lecture right now. Since our goal is to record a transaction, here is a sample transaction extracted from our comprehensive problem in the last episode. This is transaction letter D in that video. And this transaction is, supplies were purchased for 20,000, 10,000 was paid in cash, and the rest were paid after 2 months, which is in the past video is already after the reporting period. Here's how you record this transaction. So you can read this as debit supplies 20,000 and then credit accounts payable of 10,000 and then another credit cash 10,000. As you can see, the credits are written not in line with the debit. There's a little bit of indentation in both these credit account titles and these amounts. But sir, we don't understand what is debit and credit. What is that? So before we continue, let's answer that question first. So what is debit and credit? But before we answer that, let's visit again the accounting equation, which is assets equals liabilities plus capital or equity, and assign either debit or credit to assets, liabilities, and capital. But first, let's separate assets from the liabilities and the capital or equity and assign debit on the assets and credit on the liabilities and the capital or equity. Sir, okay, we have familiarized already the assignments. However, what is really the meaning of debit and what is the meaning of credit? Okay, let's make it simpler. You all know that each profession has its own technical terms, right? These terms can only be understood by the members of the same profession. Admit it or not, sometimes when we hear a lawyer or doctor talk, we barely understand what they're talking about. This debit and credit are also like these technical terms that only we who are studying accounting and business-related courses understand. So what's the use of these assignments? In the past video, I told you that assets, liabilities, and equity can increase or decrease. But instead of saying the assets increased, we say the assets are debited. And of course, instead of saying the liabilities and the capital increased, we say that it is credited. So meaning, these assignments, debit for assets and credit for liabilities and capital, are substitute for the word increase. And of course, in the opposite, instead of saying the assets is decreased, we can say that the assets is credited. And of course, if the liabilities and equity decreases, we can say it is debited. So, in the statement, liabilities is blank and the assets is blank because of the payment of the loan. When we incorporate what we have learned in the past video, we can say that the liabilities is decreased and the assets is decreased because of the payment of the loan. But if we are going to incorporate what we have learned so far in this video lecture, we can say that the liabilities is debited and the assets is credited because of the payment of the loan. So I hope you got it. And since I always emphasize that the capital can be increased by both the investment from the owners and revenues from customers, so let's assign credit to them. The same with the normal balance of the capital account. I also told you that the capital can be decreased by the withdrawal by the owners and expenses of the business. So since it deducts the capital account, let's assign to them debit. So that's it for the normal balances. But in order to make the familiarization easier, you can remember the word dealer. D stands for drawing or withdrawal by the owners, E is for expenses, and A is for assets. You remember these first three, their normal balance is debit. And of course, the last three, we have L for liability, E for equity, and R for revenues. Their normal balance is also credit. So that's the meaning of debit and credit. But before we end this slide, I will introduce you to the elements of the financial statements, which are a year, That is the acronym. Actually, this earlier is just coming from here. So actually, A stands for assets, L stands for liabilities, E stands for equity, R stands for revenue, and E is for the expenses. As you observe, withdrawal is not here, as well as the investment from the owners is not here. It is because they are still under the capital account. So why are the revenues and expenses separated from the capital, sir? It is just temporarily separated, guys, because they will be emphasized in the financial statement known as the income statement. But at the end of the year, or at the end of the accounting period, the revenue less expenses will be merged again to the capital account and will be reduced to zero. That is why this revenue and expense account are called temporary accounts. Sometimes they are called the income statement accounts. And if these are temporary accounts, the assets, liabilities, and equity are called real accounts or permanent accounts, and sometimes called the balance sheet accounts. So, that's the end for this topic. Although there is still one thing that I'd like to emphasize before we go back to the journal entries, and that's up next. I told you earlier that the elements of the financial statements are the assets, liabilities, equity, revenue, and expenses. However, guys, these elements are very general in nature. Actually, there are a lot of specific types of assets, liabilities, revenue, and expenses. As to the equity or capital, let me repeat that again. If we separate the revenue and expenses temporarily, then there are only two transactions that will affect the equity account: the investment from owners and the withdrawals by the owners. The assets can actually be subdivided into two groups. So we have the current assets and we have the non-current assets. So let's define first the current assets. So this can be converted into cash, and if it is not converted into cash, the benefit from it can be fully utilized within 1 year. So examples of this is cash, so no need to explain that. We also have marketable securities, which are investments by the company that can easily be converted into cash. And we also have receivables, particularly accounts receivable from customers, which are recognized again when you have delivered already the services or goods, but the customers did not yet pay. Another example is the inventories, which are tangible goods that the business intends to sell in the ordinary course of business. We also have supplies, and unlike inventories, supplies are items that are not available for sale. Examples are bond paper that will be used in the office or the toilet paper that will be used in the office's bathroom. And we also have prepayments or advance payments like this prepaid rent. So that's it for current assets. We have another classification, the non-current assets, or known as long-term assets also. So if these current assets are those that can be converted into cash or that can be used within 1 year, these non-current assets are those assets whose benefits can be consumed for many years. So we have a lot of examples. We have the machinery, equipment, building, and of course land. So that's it for the assets. But before we go to liabilities, let's talk about the arrangements of these accounts. Actually, this arrangement is based on liquidity. What does this mean? It means the first to appear in the list are those accounts that are converted to cash faster and are used faster. That is why, as you can see here, the cash came first because you don't need to convert it already. Followed by marketable securities and accounts receivable because they are easily converted to cash when compared to inventory, supplies, and prepaid rent. I hope that's clear. Let me repeat that again. The faster the asset account is converted into cash or the faster it is consumed, the higher is its ranking on this list. That is why current assets comes first before the non-current assets because the current assets benefits are consumed faster. For example, supplies are consumed faster than the equipment, right? Another is that, as you can see here, the machinery, equipment, and building comes first before the land. It is because these three have a limited useful life, whereas the land, it has an unlimited useful life. So that's it for arrangement. Let's go now to liabilities. These are also classified as current and non-current liabilities. So let's have their simple definitions. So we have current liabilities, which are liabilities that can be settled within 1 year, and non-current liabilities whose maturity dates are more than 1 year. So we have examples of current liability, and one of it is the accounts payable. This account is used when you purchase items on account from your suppliers. We also have unearned revenues or deferred revenues, which are actually your liability to your customer because they paid in advance before you deliver the goods and services. And we also have the salaries payable. In the non-current liabilities, we have loans payable and the mortgage payable. So to have an idea what is this mortgage payable, it is just the same with the loans. However, the creditor will ask for a collateral like a building owned by the business, so that if the debtor can't pay, they can get the collateral and sell it in an auction, for example, to recover the amount lent. So these are the only two examples here, but actually there are a lot of liabilities that you will encounter when you reach higher accounting. Let's go now to equity or capital. As I've told you earlier, if you separate revenues and expenses, only investment and withdrawal of the owners will affect the account. That is why we have only two samples of account titles here. So we have the ikasama capital, which will be used if the owners invests in the business, and the ikasama withdrawal.
Next is revenues. There are a lot of revenue accounts, but before we go to the sample accounts, let's define first revenues. So these are increases in assets, but not because of borrowing funds or investment from owners. Examples are revenues earned from customers. When you earn revenues from customers, of course, your assets will increase, but not because of borrowing funds from, let's say, for example, bank or investment from owners, right? It can also be decreases in liabilities, but not because of payment of a debt. To understand that, let's have a situation. Example, you have a debt from someone, but that someone forgot about your payable, or that someone said to you to consider that his or her gift. Then it's your gain on your part because your liability was eliminated without paying, and gain is part of revenues. So that's what that means. So let's go to the specific examples of this account. We have service revenues if you are offering services to your customers, and we also have sales if you are offering tangible goods, and we also have gains. And again, those are just examples because there are a lot of revenue accounts, like for example, interest income or gain on sale of non-current assets, and many more. Lastly, we have expenses, which is the opposite of revenues. So these are decreases in assets, but not because of withdrawal of the owner or payment of liabilities. Best example is when the company pay for salaries of the employees. So in this particular transaction, the assets will be decreased, of course, but not because the owner withdrawn funds or the company paid its debts. It can also be increases in liabilities, but the company didn't borrow funds. Example situation is when your company was guilty of food poisoning of customers and you are to pay penalties in the near future. Here, the business incurred liability even without borrowing funds. So let's go now to the specific account titles. So we have salaries expense, utilities expense, commission expense, and miscellaneous expense. So that's it for the sample accounts. Sir, one last thing. If we are assigned to arrange account titles, do we really need to list first the asset accounts before the liabilities, and then equity, and then revenues before the expenses? Yes, you have to follow that. And remember, that pattern based on this ALERE cannot be interchanged. Actually, this list of account titles is already an example of a chart of accounts to a certain company. The only thing that is lacking right here are the account codes, which corresponds to the specific account. Let's say for example, 1-01-01 code corresponds to cash. Of course, the account code should have a meaning, like when I made the sample code, the first digit corresponds to what element of FS is the account. So 1 is for the assets, 2 is for the liabilities, 3 is for equity, 4 is for revenues, and 5 is for expenses. And since the cash is an asset, I used 1 right here. The second digit, the -01 here, This one pertains to current classification or non-current classification. And since cash is a current asset, then I use -01. Otherwise, if the account is non-current, then I will use -02. And the third set of numbers is based on the specific position of the account title. What I mean is cash is the first on all the current asset, which is why I use -01 in this third set of numbers. So following the pattern, we can say that commission expense should have a code of 5-00-03. 5 is for the expenses. The next two digits is 00 because there are no current and non-current classification for expenses, and the last two digits is -03. It's because on all the expenses it is the third expense. So actually, a company can list their own account titles and design their own account codes. Now maybe some of you are asking, what's the use of the chart of accounts, sir? Actually, when you record or make journal entries, the only account titles that you can use are those that are listed on the chart of accounts. That is why we have this topic. So that's it for this slide, but before we go back to the journal entries, a bonus topic is coming up next. Since we are already talking about accounts, I would like to introduce you to the Contra Accounts and the adjunct accounts. So let's have first the Contra Accounts. What are these? These are sub-accounts to a main account, however, the balance of these sub-accounts are deducted from the main account. To understand that further, let's have the examples, which are the allowance for doubtful accounts or the allowance for bad debts and the accumulated depreciation account. Let us focus first on the allowance for doubtful accounts. This is a contra account of the accounts receivable. I would like to emphasize though that it is not the same with the doubtful accounts expense. So let's elaborate. For example, you have an accounts receivable from your customers worth 100,000 and you doubt that 5% of it is uncollectible. I told you in the past video that the effect of this transaction on the A is equal to L plus C is a decrease on the capital due to an expense and of course a decrease in asset. And actually, this expense is what do we call as the doubtful accounts expense or the bad debts expense. And this decrease in asset is a decrease in the accounts receivable. So incorporating what we have learned a while ago, we can have entries which is debit, doubtful accounts expense, 5,000, the 5% of the total receivables. Why debit? Because the normal balance of an expense is debit, right? And take a look at the capital. It was decreased, right? And decrease in capital means debit. So I hope that's clear. Next is we credit the accounts receivable for 5,000 since it was decreased. So if we do that, then we will have a balance of accounts receivable of 95,000. That's 100,000 minus the 5,000 doubtful accounts. Sir, where is the allowance for doubtful accounts? Wait, we will get to there. Actually, there are two methods in recording the doubtful accounts expense. One method is the direct write-off method. That's what we did right here. So this is the direct write-off method where we deducted the doubtful accounts expense directly against the accounts receivable. We have another method which is the allowance method. In here we are still going to debit the doubtful accounts expense, but instead of using accounts receivable in the credit, we are to change this to allowance for doubtful accounts of 5,000. And then presentation in the financial statements will become, instead of accounts receivable 95,000, we're going to recognize accounts receivable at gross of 100,000, but we will deduct the contra asset allowance for doubtful accounts balance of 5,000 to get the net realizable value of 95,000. So that's it for the allowance for doubtful accounts. But before we go to the accumulated depreciation, if you are asked what is the normal balance of allowance for doubtful accounts, then your answer should be credit. Let's go to accumulated depreciation account. So this is a contra asset of depreciable assets like machinery, equipment, building, and etc. To understand further, we have an example. So you have an equipment worth 100,000 and it has a useful life of 10 years. So here, since there is no salvage value, 100,000 will become the depreciable amount immediately or automatically. Then you divide it by 10 years, so the depreciation is 10,000 per year. So I told you in the past video that the effect on the assets equals liabilities plus capital will be a decrease on the capital because of the depreciation expense, and of course it's a decrease also on the equipment, on the assets. So if we're going to have an entry, we're going to debit depreciation expense of 10,000 and we are supposed to credit equipment for 10,000. Unfortunately, there is no direct write-off here. Not the same with the direct write-off here in the allowance for doubtful accounts. So we cannot use the equipment account. Instead, we are going to use the accumulated depreciation dash equipment of 10,000. So in the presentation, we're going to present equipment at its gross of 100,000 and we are going to deduct the accumulated depreciation equipment balance of 10,000. Then we will have 90,000, which is what do we call as the book value of the equipment. I'll give you another bonus knowledge. So this account, the accumulated depreciation is cumulative in nature. That means, based on this illustration, you have 10,000 in year 1. However, in year 2, it will become 20,000. And in year 3, it will become 30,000 and so on. So now, before we go to adjunct accounts, I would like to emphasize two things, and that is, number 1, allowance for doubtful accounts and the accumulated depreciation is very different from their expense counterparts, the doubtful accounts expense and the depreciation expense. And number 2, these are just two examples of contra accounts. Actually, there are a lot of contra accounts. So that's it. Let's go now to the adjunct accounts. So these accounts can still be considered as sub-accounts of a main account, just like the contra accounts. However, their balances adds to the balances of the main accounts. That is why this is called the opposite of contra accounts. Example is, when your company buy and sell goods. For example, you bought inventories for 100,000 and paid 3,000 for transporting the goods. The question is, how much will be capitalized as inventories? To answer that, we have of course the purchase cost of 100,000 and the freight in of 3,000. So all in all, the capitalizable cost is 103,000. By the way, freight in is an example of an adjunct account. And that's it for this slide. But before we go back to journalizing, I would like to tell you that you will encounter a lot of these accounts in the future. Now, let's go back. So, we are now back. So let's analyze again the transaction, of course, with the newly acquired knowledge a while ago. But before we do that, I told you earlier that this can be read as debit supplies, and then we have two credits, the accounts payable and the cash. So let's go back to the transaction. The transaction says supplies were purchased for 20,000, 10,000 was paid in cash, and the rest were paid after 2 months. So let's see if this is correct. Of course, the supplies is correct. It is to be debited because the supplies increased. And of course, the cash credit is also correct because the cash decreased because of the down payment. And the accounts payable increased because of the unpaid balance. So it is correct that it should be credited. As you can see here, there are 2 credits and 1 debit. So actually, this is what do we call as the complex entry. So if you are going to see only 1 debit and 1 credit, that is what do we call a simple entry. Actually, you can have a lots of debits and credits as long as the debit balances equal the credit balances. So like we have this one. So the debit is 20,000 and also the credit total 20,000 also. Guys, before we go further, I would like to tell you that the data for the transaction, like for example in this, we have 20,000, the amount of the supplies as well as the payment terms are found on the source documents. So what are these source documents? These are actually papers that are considered evidences that a transaction really happened. So examples of which are the purchase order, sales invoices, and official receipts from your supplier, for example. So that's it for the source documents. Now guys, I would like to tell you that this is not a complete journal entry. Actually, a complete journal entry includes a date, 315xxxx, and of course, an explanation on the transaction, which is in here we have to record supplies purchased partially on account and the down payment per sales invoice 0050 dated 315 for excess. And aside from that, you are going to have a number sign if this is already the last transaction for the day. So that's it for journalizing. Of course, we will not end this particular video without a comprehensive illustration. So now let's apply. So we have here the illustrative problem. Actually, this illustrative problem is coming from the last video. Actually, there are two sets of transactions that were presented in the last video. The first one is this one, and the second one are the transactions for adjustment. So for this particular video, we are going to ignore the second set of transactions. And of course, we're going to add here the account list so that we can journalize. Aside from that, we are going to ignore some parts of a complete journal entry. Let's say, for example, the date, as well as the explanation, as well as the number sign in order to maximize this space. With that, let's start. So in letter A, since the owner invested 100,000 to open the business, so the business received cash, so we are going to debit cash 100,000, and of course we're going to credit Glet's capital 100,000. Reminders again, you cannot use any account title which is not listed on this account list. So that particular reminder, it's because of transaction letter B. So you have paid business permits and licenses 2,300. In here, we do not have any expense account that is for business permits and licenses. But we know that it's an expense. So it's better to use miscellaneous expense 2,300 and credit cash 2,300. Next is letter C. So you have paid advance rent for 5 months. So what will you do? Of course, debit prepaid rent 15,000 and credit cash 15,000. Transaction letter D has already been answered and analyzed earlier. So we debit here supplies 20,000 and cash credit for the down payment, and the unpaid balance is credit accounts payable of 10,000. And of course, on letter E, since you have purchased a new asset, then we are going to debit office equipment 30,000, but we're going to credit cash 30,000 because we have sacrificed the cash. In letter F, when you are going to pay salaries, then you are going to debit salaries expense 30,000 and then credit cash 30,000. And in letter G, you've paid for utilities, so you debit utilities expense 19,750 and credit cash 19,750. In letter H, you have received advance payment from customers, so you're going to debit cash 80,000. However, you're not going to credit service revenues yet because you have not delivered any services or goods yet. So what are you going to credit? It's the unearned service revenues, which is a liability account. So unlike H, letter I, the clients paid 40,000, so debit cash 40,000 for services already rendered. So the credit is service revenues 40,000. And last but not the least, we have the last transaction. The owner withdrew 25,000 for personal purposes, so that's a credit to cash, and of course a debit to Glet's withdrawal. So that's it for this particular video. If you liked it and if it helped, then please click like and subscribe, and of course share this video to those who need it. And if you have questions, place it in the comment section below. So next is step 3 and step 4.